On January 1st, 2026, a regulatory document that the Bank for International Settlements had been building for 3 years quietly went live. Most people in crypto did not read it. Most financial journalists did not explain it. And 4 weeks later, $467 billion was erased from cryptocurrency markets in 7 days, the worst week since the FTX collapse. The document is called SKO 60, and if you have not read it, you are making every single positioning decision in this market without understanding the ground you are standing on. If you are new here, welcome to the Wealth Continuum. This channel exists for one reason, to give you the structural picture underneath the price action, before the price forces you to pay attention. Subscribe right now, turn on notifications. Tell me in the comments where you're watching from. This channel reaches viewers across 60 plus countries, and every single one of you is trying to make sense of a market that just handed most people their worst month since the FTX collapse. I'm going to give you the full picture today, not the emotional reaction, the structure, because here is what almost nobody is saying right now. What you just watched happen to Bitcoin. The crash from its all-time high of $126,000 set in October 2025 down to $68,000 today, a 46% decline, is not happening in a vacuum. It is happening inside a regulatory environment that fundamentally and permanently changed on January 1st, 2026, 6 weeks ago. And the connection between that regulatory shift and the bloodbath you just witnessed is the story that will define Bitcoin's market structure for the next decade. And almost nobody is talking about it seriously. Stay with me, because once you see this, you cannot unsee it. Let us go back to January 1st, 2026. While most of the world was celebrating a new year, a document that the Bank for International Settlements had been working on for over 3 years quietly went live. The Basel Committee on Banking Supervision, the body that sets global capital standards for every major bank on Earth, implemented what is known as the SKO 60 cryptoasset prudential framework. In plain English, for the first time in financial history, there is now a binding, globally coordinated rulebook for how internationally active banks must account for digital assets on their balance sheets. Not a proposal, not a consultation paper, not a guideline, a rule. Live now. And the centerpiece of that rule, so the number that should have been screaming from every financial headline in January, is 1,250%. That is the risk weight assigned to Bitcoin and every other unbacked cryptocurrency under the Basel framework as Group 2 classification. Risk weight is the multiplier that determines how much capital a bank must hold against any given asset. A U.S. Treasury bond carries a 0% risk weight. Banks need to hold essentially no buffer capital against it. Investment-grade corporate debt runs somewhere between 20 and 100%. Even junk bonds, genuinely speculative, genuinely risky instruments, do not approach anything close to what Basel has assigned to Bitcoin. Bitcoin gets 1,250%. That means for every single dollar of Bitcoin that a regulated, internationally active bank wants to hold on its balance sheet, it must set aside $1.25 in Tier 1 capital as a regulatory buffer, dollar for dollar. And on top of that, banks are hard capped. Their total Group 2 crypto asset exposure must stay below 1% of their Tier 1 capital, with punishing cliff effects if that line is crossed. A research note from Greenwich Sound Capital put it bluntly: the framework requires $19.6 million in regulatory capital to support just $1.57 million in Bitcoin exposure. That is a 504 to 1 capital disadvantage versus tokenized traditional securities, 504 to 1. You need to understand this before you make your next move, because this number is not accidental. It was designed. And the question of who it was designed to benefit and who it was designed to shut out is the most important question in the entire crypto market right now. But here is where the mainstream narrative completely breaks down. Most people in crypto heard about Basel III as crypto rules and concluded one of two things. Either it proves Bitcoin is finished, or it proves the government is scared. Both of those readings miss the point so completely that they will cost you money. Because what Basel III actually did, when you read the architecture carefully, is not ban Bitcoin. It is not even slow Bitcoin down in isolation. What it did was create a regulatory fault line, a structural divide between the world of global banking under the Basel framework and the world of crypto operating outside it. And that fault line is now live. And it is reshaping everything about how Bitcoin's price is discovered, who holds it, who sells it, and why the February crash happened with the particular structure it did. Here is what almost nobody is talking about. The February 1st liquidation cascade, the 2.2 billion in a single day, the 93% of wiped positions being long bets. That was not simply a macro shock. It was the first major deleveraging event in a post-Basel implementation market. In the absence of the traditional institutional buyer of last resort, the regulated bank sitting on a clean balance sheet, able to step in and absorb discounted Bitcoin during a crash, is no longer a temporary phenomenon. It is now a structural feature of this market. Banks that might have previously accumulated Bitcoin during corrections cannot do so affordably anymore. The capital cost to absorb even a relatively small position is prohibitive. So who fills that gap? The answer to that question tells you everything about where this market goes from here. Comment below right now. Do you think the Basel III implementation is the hidden factor that made the February crash worse than it needed to be? Because the leverage data supports that argument more strongly than most people realize. Let us go deeper into the liquidity picture. Because the Basel III story does not exist in isolation, it is layered on top of a Federal Reserve and macro backdrop that is the most complicated and uncertain environment Bitcoin has faced since its inception. As of today, February 18, 2026, the Federal Reserve is holding rates at 3.5 to 3.75%. That is where they have sat since the third cut of a rate cutting cycle that began in September 2024. 3 cuts, 175 basis points of easing, spread across the final months of last year. And here is the brutal irony. Those rate cuts, which markets had been celebrating as the beginning of a new liquidity expansion cycle, did not deliver the risk asset relief that everyone expected. Because the macro environment absorbed those cuts and neutralized them. Tariff-related inflation pressures, geopolitical instability in the Middle East, a U.S. government shutdown threat that rattled markets in early February. All of it converged on a market that was leveraged to the long side in ways that were historically extreme. And then, on January 30th, 2 days before the February 1st liquidation event, President Trump nominated Kevin Warsh to succeed Jerome Powell as Federal Reserve Chair. Powell's term as chair expires in May of this year. Warsh, 55 years old, former Fed governor, Wall Street background, has publicly called for rate cuts and described the current Fed leadership's track record as, and I am paraphrasing here, one of unwise choices. The market's initial read was bullish. A more dovish Fed means more cuts, means more liquidity, means higher risk assets. But when you dig into the detail, the picture is far more uncertain. Warsh has a documented hawkish history. He was the Fed governor who pushed for higher rates during Ben Bernanke's tenure. And the market itself is only pricing in roughly a 48.5% probability of a rate cut at the June meeting, which means, with near certainty, the next cut, if it comes at all, is months away. Meanwhile, current St. Louis Fed President Alberto Musalem said clearly that the current rate level of 3.5% is at neutral, neither restricting nor stimulating growth, and that with inflation still above the Fed's 2% target, he does not favor cutting. Core CPI came in at 2.5% in January 2026. Not alarming, but not solved. And in the confirmation hearings that will determine whether Warsh takes the chair, the signal his testimony sends about the path of rates will move markets more than almost any other macro variable between now and May. But here is where it gets dangerous, genuinely dangerous, for the Bitcoin holder, who is looking at the current price of $68,000 and asking whether this is the bottom. The Federal Reserve's rate stance is only one piece of the liquidity equation. The other piece, the one that drove so much of the 2023 and 2024 bull market, and that is now quietly reversing, is the structure of Treasury issuance and the banking system's capacity to absorb it. The U.S. Treasury has been issuing debt at a historically elevated pace. The combination of deficit spending, interest costs on existing debt, and the rollover of maturing obligations is creating a supply wall in the bond market that is not getting enough attention. And the banks that are supposed to intermediate that supply, the primary dealers obligated to bid at Treasury auctions, are now operating under tightening capital constraints. Basel III is not the only force squeezing bank balance sheets. The broader regulatory environment, even after the Trump administration's easing on crypto-specific rules, still requires banks to maintain elevated capital buffers across their entire asset base. That means less capacity for risk-taking, less capacity for stepping in as buyers during market dislocations, less capacity for providing the kind of liquidity cushion that historically moderated crash severity in every asset class, including Bitcoin. And this brings us to something that almost nobody in the crypto world is tracking with the seriousness it deserves. The January CoinShares data just confirmed that digital asset investment products recorded a second consecutive week of outflows totaling $1.7 billion. Year to date, net outflows from Bitcoin ETFs already total $1 billion, and we are only 7 weeks into 2026. James Butterfill, head of research at CoinShares, described it as a, quote, marked deterioration in investor sentiment toward the asset class. Not toward a specific coin, toward the asset class. That is a sentence worth pausing on. This is what smart money is watching right now. Not the price, not the RSI, not the social sentiment metrics. They are watching whether the ETF outflow trend reverses, stabilizes, or accelerates. Because the ETF flow signal is now the single most important institutional demand indicator in this market. It is more reliable than open interest. It is more telling than funding rates. And right now, it is telling a story of structured withdrawal. Let us now lay out the three scenarios that should be governing your thinking as of today, February 18th. Not predictions, frameworks. Because anyone who gives you a confident prediction in this environment is either lying to you or lying to themselves. Scenario 1, the regulatory and monetary pivot unlocks the next leg. In this scenario, Kevin Warsh is confirmed quickly. Cuts rates twice before year end, and the U.S. domestic crypto framework, already significantly more permissive under Trump, becomes the global template that other jurisdictions feel pressure to adopt. The Basel Committee, already signaling a need to revise its framework, backs away from the 1,250% risk weight under pressure from the US and UK. Banks, freed from punitive capital treatment, begin accumulating Bitcoin directly rather than through wrappers. ETF outflows reverse as institutional confidence returns. The $60,000 low established during the February crash holds as the cycle's bear market floor, consistent with historical post-halving corrections of 40 to 50% from peak. From that floor, Bitcoin retraces toward its all-time high and beyond. Analysts at VanEck, in a January 2026 projection, maintained their long-term view that Bitcoin could reach $2.9 million by 2050, with 15% compound annual growth. The near-term version of that trajectory puts Bitcoin back above $100,000 within 12 to 18 months if scenario 1 plays out. The technical picture supports it. The Bollinger Band analysis, as of today, shows Bitcoin's percentage band position near the lower range, suggesting the sell-off momentum may be approaching exhaustion, with the next resistance level at 69,605 and a breakout target towards 71,250 at the middle band. But here is where it gets dangerous for the people counting on scenario 1. Even if the monetary environment improves and the domestic U.S. regulatory posture stays permissive, the global Basel III split does not disappear. European and Asian banks remain constrained. The pool of natural institutional buyers remains structurally narrower than it was before January 1st. And a rally built on a narrowing buyer base, US only, wrapper-mediated, ETF-driven, is categorically more fragile than the broad, deep institutional accumulation that a genuine structural bull market requires. In scenario 1, the rally happens, but it happens on a foundation that cracks more easily than the previous cycles did. Scenario 2, inflation re-accelerates and the Fed cannot cut. This is the scenario that the tariff story makes genuinely plausible. If the Trump administration is a tariff policy, already in effect and already being cited by economists as a potential upward pressure on consumer prices, pushes core PCE back toward 3% or higher, Warsh's ability to cut rates evaporates regardless of his intentions. A Fed that wants to cut but cannot, combined with a Treasury market absorbing record supply, combined with a Bitcoin market that just flushed $467 billion in a week and has not fully cleansed its long side leverage, that combination is one of the most dangerous macro environments for risk assets imaginable. In this scenario, Bitcoin does not stabilize at 68,000. The 52-week low of 60,187, the number printed during the February crash, gets tested again. And if it breaks, the historical analog for a post-halving bear market that goes deeper than 50% from the peak becomes very real. John Blank, chief equity strategist at Zacks, told CNBC's Squawk Box Europe just 2 weeks ago that he believes Bitcoin could hit $40,000 this year. He said, and this is worth sitting with, we can get there very quickly, or more likely, over the next 6 to 8 months. 40,000. From an all-time high of 126,000. A 68% decline. That is within the historical range of past Bitcoin cycle corrections. Uncomfortable to say, but structurally possible. Scenario 3. The geopolitical shock arrives before the monetary picture resolves. Look at what happened on February 1st. The liquidation event that erased $2.2 billion in a single day was not purely a Bitcoin story. Gold and silver saw rare double-digit percentage declines on the same day. The S&P 500 fell. Nasdaq dropped. The crypto market shed losses while traditional markets recovered. And crypto did not, at least not at the same speed. That divergence is a data point. An explosion in Iran and Middle East escalation were cited as contributing factors. A U.S. government shutdown threat added to the uncertainty. In a genuine geopolitical shock scenario, a conflict escalation, a sovereign debt crisis in a major economy, a banking system disruption in Europe tied to the Basel III transition costs for banks that are now forced to hold punishing capital against existing crypto positions. The initial move is always the same. Everything sells, cash is king, and the correlation between Bitcoin and risk assets goes to 1. Temporarily. The question, as always, is what comes after the initial shock. Because every genuine liquidity crisis since Bitcoin's inception has eventually been met with an emergency monetary response. And every emergency monetary response has ultimately been bullish for a fixed supply, non-sovereign monetary asset. The critical variable is whether you are still in the market, properly sized and unlevered, when that response arrives. Or whether you are one of the 335,000 traders who got flushed on February 1st and are watching the recovery from the sidelines in cash with a loss you cannot bring yourself to crystallize. And this is the positioning trap in its most current and most dangerous form. Not the leverage trap that already closed, the psychological trap that comes after it. The trader who bought Bitcoin at $100,000 is now staring at a 32% loss. The one who bought at $90,000 is down 25%. The one who bought the 76,000 dip on February 1st and got stopped out near 60,000, that person is not thinking clearly right now. They are anchoring to their entry price. They are waiting to break, even before they reassess. And they are missing the structural picture entirely, which is the only picture that matters. Here is what the structural picture actually says as of February 18th, 2026. Bitcoin's Bollinger Band position, with the lower band at 61,206 and the upper band at 81,306, puts the current price in the lower third of the range. The daily average true range of $4,173 tells you that volatility remains elevated, that a 4 to 5% daily move in either direction is not a surprise, it is the baseline. The critical support level that every serious analyst is watching is $65,889. If that holds, the technical case for a recovery toward 71,000 and then higher remains intact. If it breaks, the next real support is the cycle low near 60,000. And below that, the chart becomes genuinely open-ended. Now, layer the Basel III regulatory reality back onto that technical picture. You have a market where the traditional institutional safety net, the regulated bank with a clean balance sheet that steps in to buy during corrections, is either constrained by the global Basel framework or has not yet been replaced by a domestic alternative. You have ETF flows that have been net negative for 2 consecutive weeks. You have a new Fed chair nominee whose confirmation timeline introduces uncertainty into the rate outlook for the next 3 months at minimum. You have a geopolitical environment where the Middle East remains unstable, where tariff policy is creating inflationary pressures that the Fed cannot simply ignore, and where the DOJ investigation into Powell is injecting an unprecedented level of political noise into monetary policy discussions. And you have a global regulatory war over who controls the future of digital finance, a war in which the US has staked out a permissive position and the rest of the world has not yet decided whether to follow or resist. Share this video with someone who is looking at the $68,000 price and thinking the answer is obvious in either direction. Because the answer is not obvious. The structural complexity here is real. And making decisions based on incomplete understanding of that structure, in either the bullish or the bearish direction, is how you end up as part of a liquidation statistic. Subscribe to the Wealth Continuum if you want to track this regulatory story the way it deserves to be tracked, jurisdiction by jurisdiction, implementation timeline by implementation timeline, data point by data point. Because the Basel Committee has already signaled that the SCO 60 framework needs revision. That revision process will take months, possibly years, and every data point along that journey, every central bank position paper, every Senate confirmation testimony from Kevin Warsh, every Fed funds futures print, every ETF flow report, is a piece of the map that most investors are not reading. Let me close with the macro dimension that ties everything together and that most people are not giving enough weight to. The Bitcoin all-time high of $126,000 was set in October 2025. At that moment, the narrative around Bitcoin was as strong as it has ever been. ETF assets under management had exceeded $120 billion. Institutional adoption felt not just plausible, but inevitable. The halving had compressed supply. The Fed had begun cutting rates. And the geopolitical argument for a non-sovereign store of value had never been more credible in the eyes of mainstream finance. And then, between October and February, nearly half of that price evaporated. Not because Bitcoin changed, not because the underlying monetary thesis changed, but because the macro environment that was holding the price at those levels, the liquidity, the leverage, the positioning, the sentiment, could not hold. And the regulatory shift of January 1st removed one of the structural supports that might have cushioned the fall. But here is the thing about structural shifts. They do not only destroy, they also create. The Basel III framework, even as it constrains direct bank exposure, is accelerating the development of regulated financial wrappers for Bitcoin. The ETF market, despite current outflows, is now a permanent infrastructure. The custody solutions, the derivatives market depth, the options market, the institutional research coverage, all of that exists now in ways it did not during previous bear markets. The infrastructure for the next institutional wave is more developed than it has ever been. The question is not whether that wave comes. The question is what macro and regulatory conditions need to align for it to arrive. And that alignment is not here yet, but it may be closer than the current price suggests, or further away than the current sentiment implies. The last time Bitcoin corrected this sharply from an all-time high, November 2021, to June 2022, most people who sold near the bottom did so believing the cycle was over. They were wrong about the ultimate destination, but they were right that the timing was not yet right. And that distinction between being right about the direction and being right about the timing has destroyed more capital in this market than any other single error. You are now seeing the macro picture that most people watching the price chart are not seeing. You are seeing the regulatory architecture that most crypto YouTubers are not explaining. You are seeing the Federal Reserve transition that most analysts are not connecting to Bitcoin. That knowledge is the beginning of a better decision. But knowledge without patience, without position sizing, without a plan for all three of the scenarios I just walked you through, that knowledge becomes noise. And noise in this market is expensive. Comment below. Tell me which of the three scenarios you think is most likely as of today. Tell me whether you are positioned defensively, aggressively, or sitting in cash. Tell me how you are thinking about Basel III's global rollout and the US decision to go its own way. This audience thinks structurally. I want to see that thinking in the comments. The next move in this market will not reward the loudest conviction. It will not reward the most confident prediction. It will not reward the trader who is most certain about direction. It will reward the investor who understood the structure, the regulatory environment, the liquidity dynamics, the leverage map, the macro backdrop, before the structure forced the market to move. The people who walked into February 1st with full long exposure and no plan were not stupid. They were unprepared. There's a difference. And in a market where 2.2 billion can vanish in a single day, unprepared and wrong are the same thing. The rules changed on January 1st, 2026. The market has not fully priced that in yet. The question you need to answer before your next trade, before your next allocation, before your next decision is simple. Which side of this new structure are you on?